Good morning, everyone. This is JJ Risha with Pismo Ventures, and I have with me today Dr. Fred Haney, and of course, Stephen Kusama, who is the power behind everything we've been doing lately. So Dr. Fred Haney will introduce himself in a couple of minutes. I just wanted to tell you a little bit about what's going on. So today, we're going to talk about the Fundable Startup. Dr. Fred Haney has a book about that, so I hope you all will be able to also take a look at the opportunity of purchasing that book too. We have a lot of webinars. We had a great webinar yesterday and one on Tuesday as well. So we have a lineup of webinars for the next 4 weeks. Please make sure you take a look at them. We will continuously remind you as well about all the different webinars that are coming up. Also, we have a virtual networking time right after this webinar is done. So the virtual networking will start as early as 10, but as long as we're still here, we're going to stay with the webinar until it's done. Then we'll jump over to the virtual networking. There is a link that Stephen just put up in the chat. It's called it's HIO Social App. So you've all been registered already. So if you need a password for some reason, the password is Fundable 2020 VIP. Also, it is in the chat. Just to give you an update on the competition, the deadline for the competition to apply is this Sunday at midnight. You also must provide all your submission materials, which is a 15-slide deck, a 3-page plan, and a 60-second video pitch. We will have about 2 weeks between now and October 12th, where the second round will happen. So during the first round, there's no live judging. What we will do is we will be looking at all the applications and scoring them, and then the companies with that have the highest score, the 100 companies that have the highest score, will move to round 2 for live judging starting October 12th. So again, deadline is this weekend, this Sunday at midnight. Please submit your materials. Dr. Haney, the floor is yours. Please just give us a minute or two about your background, and then you can go ahead and start the webinar as you wish.
Good morning, JJ. Thanks. Hi, all. Nice to be with you. I'm looking forward to our time together here. As JJ said, I've been working with startup companies for a long time. I'm not going into the details yet because that's a part of the PowerPoint presentation I have put together. But the point is that I've worked with startups both as a corporate executive, strategic planning manager, large companies, venture capital fund manager, an angel investor, and I've also been a co-founder of half a dozen companies. So I'm going to do a screen share here and go through some slides with you. I didn't get the slide that I thought I was going to get. There we go. So this is the cover of the book I wrote that JJ talked about. It's called The Fundable Startup, and it deals with the issues surrounding startup companies, early stage companies, and getting them funded. And in July, it achieved bestseller status on Amazon. I'm going to give you a quick look at the things we're going to talk about today. I'll give you a little background about myself. I will do the introduction that JJ promised. We'll talk a little about a thing called Steve Jobs' Law. I'll summarize the logic of the Fundable Startup, kind of how I'm thinking about startups. We'll talk about competing for capital, which is what startup companies have to do. We'll talk a little bit about VCs, how they think about things, how many deals they do, what's their perspective on startups. We'll define what the VCs mean by a good deal. And when I say VCs, by the way, you could substitute angel investors probably. I mean, this isn't just about going to venture capital funds. Any serious investor is going to play by pretty much the same rules. We'll talk about what it means to attract capital. The subtitle of my book is How Disruptive Companies Attract Capital, and that has a special meaning. We'll talk a little about risk and how you manage it. How do you think about value in a startup company? What does it mean for a CEO to be fundable? Are there shortcuts to becoming a fundable CEO? We'll talk about some case studies, some specific companies that got a fundable CEO in place and how they did that. Company building skills is important. It's the company building skills of building a startup are a little different than the kinds of things you learn in traditional management. And that's an important thing for founders to understand. Little broad brush comparison of entrepreneurs and CEOs. Bootstrapping is an important concept. It's a way for companies to get over some of these hurdles. We'll talk about advisors, what kind of advisors you should be looking for. A little about crowdfunding, more from the investor's point of view and kind of what the issues are there. And finally, some thoughts about pitch decks. So here's a little of my background. I've been involved for over 50 years. I've worked with probably a couple hundred startup companies, hands-on with around 100 probably. I started my career with a company called Scientific Data Systems. It was a small manufacturing company in California, computer manufacturing. And shortly after I joined, it was acquired by Xerox. And Xerox turned me into a corporate strategic planning manager. At one point, I ran strategic planning for 7 business units of Xerox here on the West Coast. Not the copier business, it was everything else. It was computers, workstations, Ethernet, the Star workstation, which turned out to be the Apple Macintosh. So I was working with, and then there were probably another dozen startup companies inside Xerox that were competing for capital, trying to get launched. Then I did similar things at Computer Sciences Corporation and TRW. At TRW, I ran a division for a year and a half and sold it to California Microwave. And I also sold the Datacom International business of TRW to Data Point Computer Products. That was a $115 million cash deal. In the 80s, I got recruited by 3i Group, which is the largest venture capital company in the world. 3i Group is a big British bank consortium. They recruited me to set up and run a high-tech venture capital fund. It was called 3i Ventures. We invested $80 million in 60 different companies with an end result of 20 IPOs, 20 acquisitions, and 20 dead companies, and an overall return of about 25%, which for the time frame was amazing. In 1992, we tied Sequoia for the most number of IPOs, 7 in 1 year. In 1997, I worked with Luis Villalobos and 9 other people as a co-founder of Tech Coast Angels. We started that, and it turned out to be one of the larger angel groups in the country. I served on the original board of governors and for 7 years. And then after about 2000, I've been a co-founder of 6 different startup companies. So that's kind of the thinking behind my writing of the book. You know, you don't take that kind of a decision lightly. And I'm very embedded in competitive strategy. I actually took Michael Porter's competitive strategy class. So I wasn't going to write a book unless I thought it had some competitive advantage and some things that would make it different. And this is what I thought would make it different. my experience is not just over a long time, but it's from a lot of different perspectives. And I've tried to weave that into the book. So one of the things that, I'm going to jump into these slides. I'm happy to have you interact if you have questions about the specific slide. Let's not wander off, but if you have comments or questions about the slide I'm talking about, feel free to raise your hand for JJ and jump in. There's a thing called Steve Jobs' Law. It's not widely published, but it was published a number of years ago. And Steve Jobs said, founders make the best CEOs. Well, easy for him to say. I mean, Steve Jobs was a good CEO eventually. And there are some, it's probably true that if you look at some of the best mega companies in the high-tech world, that they were in fact run by the founders. But that's also an exception. I mean, in my experience as a venture capitalist and the experience of other venture capitalists, founders don't usually make the best CEOs. They don't usually have the kind of experience that it takes to build a successful company. So this Steve Jobs Law was one of the things that sort of propelled me to write the Fundable Startup, because my experience was just different. I mean, out of 12 companies where I was directly involved, 3i, I made investments directly. You know, I managed the fund, but I also was a direct investor in 12 companies. In 7 of those, I had to replace the CEO because things just weren't going right. So here's a little summary of the overall logic of the Fundable Startup. You know, how am I thinking about things? First of all, investors have lots of deals on the table. They've got their pick of the best ideas and the best CEOs and management teams. And it's important to understand that. I mean, the VC you're talking to has dozens of business plans on his desk. And some of them have really good ideas. Some of them have CEOs and management teams that have built companies before. So it's important for startups to understand that they're having to compete against companies like that, other startups with those kind of credentials. And with respect to management, it takes 15 to 20 years most of the time to become a seasoned CEO. Most CEOs are 45 or over. So when you put that together, you've got to have a strong team if you really expect to get capital from a venture capital fund or from any investor for that matter. But there are some things you can do regardless of the past experience of your team. There are some things you can do to create market traction, reduce the risk to investors, and basically prove that you know what you're doing. So it's not all hopeless. I mean, the fact that you don't have 20 years experience as a CEO doesn't knock you out. It just gives you a few additional hurdles that you're going to have to jump over. Let's talk for a minute about how many deals the VCs do, how active they are. I said to a friend a couple months ago, we were talking about this, and he said to me, he said, you know, the VCs do less than 1% of the startups. They're hardly even a factor. I mean, they'll tell you they do like 1 out of 100. Well, that's true, but if you look at the companies that are going public, 1/3 of them have venture capital backers. So what does that tell you? You know, yes, it's true the VCs are being extremely selective, but somehow they're involved with 1/3 of all the companies that are going public. What that tells me is that they're doing a pretty good job of cherry picking some of the best deals out of the pile of 100. And that's important to remember. I mean, don't think of the VCs as irrelevant. Just think of them as pretty good at figuring out which couple of deals out of 100 are likely to be initial public offering opportunities. It's really important to understand that the venture capitalists or any investor you're talking to, angel with business plans decks, done it before. Why wouldn't he do that deal? You know, why would he do settle for anything less than that? So you have to compete, and it's very important for startups to understand that they're competing against other startup companies for capital. I mean, the reputation that a lot of high-tech startups have is they invent a better mousetrap, and they expect the world to kind of beat a path to their door because they've got this wonderful mousetrap. But it's not like that. I mean, you're really having to take your mousetrap out and convince investors that you're better than the other companies. So, and that's not an easy thing to do. The hurdles are quite high. It's important to understand where investors are coming from, whether you're talking about VCs or angel investors. At least in the case of venture capitalists, they're managing other people's money. Well, what's the significance of that? Well, the significance is that they're going to be real careful not to lose very much of other people's money if they can avoid it. It makes them risk adverse. They're going to manage risk very carefully. We'll talk about that some more later, but that's an important part of the venture capital thought process. You know, what are the risks around this project? Can I live with them? Can I mitigate them? Or should I just go on to a different project? But the fact that they're managing other people's money is a significant factor. In the case of angel investors, they're probably managing their own money, so they don't quite have that problem. But they're risk adverse for a different kind of reason. You know, that because they're managing their own money, and they don't have, at least not all of them have tons of it, so they're having to be careful, or their spouses are going to get really bad at them if they lose too much. And like the guy at the desk a minute ago, the VCs and angel investors are probably seeing 100 deals a month. I mean, if it's not 100, it's 50, and in some cases, it's probably a couple hundred or 300, depending on the reputation of the venture capital firm. So they have their pick of the best deals, and somehow you've got to rise to the surface in the middle of that. What they're looking for, to simplify it, is what I would call a disruptive idea. By disruptive, I mean big, you know, has the potential for significant opportunity. The hurdle used to be like $100 million in sales. That's probably still a good number. Not many companies reach $100 million in sales in a 5 to 7 year period of time. But some people would say it has to be even bigger. You know, it has to be a unicorn. It has to be a $1 billion IPO within 5 years. That's very hard to figure out which companies are going to accomplish that. But it's a sort of hurdle rate for the venture capitalist. and then finally, they know that they're going to need management teams that can make it happen. So they want what I would call a fundable management team. In the best of worlds, it's people who have done it before, so they can go back and look at resumes and past experience, and they may have a team that's done it before, or even within the same space, within the same industry segment. That does happen. I mean, there's repeat offenders within some of the same industry sectors. So that's what you're competing against, and it's important to understand that. The management issue, from an investor's point of view, it's a risk issue. If they have a team that's done it before, that removes a lot of the risk. I mean, one of the big risks is, can management execute it? Do we have a team that will be able to achieve its objectives and make this work? I mean, one way to get over that hurdle is if you've got a team that's done it before. If your team hasn't done it before, now you've got to do a lot of reference checking and find out. I mean, it's okay. I mean, that's what VCs do all the time. But now they're more dependent on reference checking and trying to figure out how likely the people are to be successful. So this is another way of saying, what do we mean when we talk about a good deal? Most of them, all of the companies have a hockey stick kind of growth forecast. That's not unusual. But the important thing from a venture capitalist point of view is the forecast defensible? Are there numbers to back it up? Can we do some due diligence and go do some market research and competitive analysis and get comfortable that those kind of numbers are achievable? How much, when they went out and did their analysis, can defend their forecast? That's a very important part of making presentations, to be able to defend your revenue and profit forecast. And then again, the more successful a management team and CEO have been in the past, the better from an investor's point of view. So the subtitle of the Fundable Startup is How Disruptive Companies Attract Capital. My concept there is, look, you can run around pounding the pavement, banging on doors forever. That's a difficult way to raise money. It's important to remember that VCs are looking for good deals. I mean, they're in the business of going out and trying to find attractive investment opportunities, which means deals where they're priced reasonably, where they think they can make an attractive return on investment. Again, they have a really good, compelling idea and a strong management team. So VCs are out looking for those kind of deals. So you shouldn't have to pound the pavement if you've got that kind of a deal. If you've got a deal that really represents a good opportunity, now it just becomes a problem. A challenge of packaging it up in an attractive way and getting it in front of the right people. And again, VCs are not, I mean, they're not hard to find. Angels aren't hard to find. We have to find several lists of the venture capitalists and angel investors, along with email addresses. Is it better to have an introduction in contacting them? Sure. But it's not absolutely necessary. I mean, again, they're in the business of looking for good opportunities. The point here that a good deal solves an important problem is an important point. It's not just that there are lots of potential customers, it's also that the need is strong. The customers really need the product. It solves a problem that they can't solve today, or it solves a problem in a better way. And the buying equation is compelling. That's important. You know, it's a strength of customer attraction is important. It's really important to think through what it means to manage risk from an investor's point of view. Investors know they're going to accept some risk, but you know, they have their limits. They don't want too much. They don't want so much risk that companies fail. So let's think through in sort of a sequential way what some of the significant risks are. The first is just the technology feasibility. Is the technology viable? Is it realistic? Can it be done today? Does it really work? Is it cost effective? Can the product be developed? Can the product be manufactured at the kind of cost that management is projecting? Does the product work? Does it solve the problem it's supposed to solve? Will customers in fact buy the product? Do customers like the product? Are they coming back for more? How strong is their buying motivation? And finally, can the management team execute its plans effectively and make all this work? So if you have a bright idea in a laboratory and you approach investors with nothing more than your bright idea, you're basically presenting them with all these risks. I mean, the list here of 9, there's probably more if you went into more detail, but you're basically asking an investor to sign up for all these risks. It's difficult for an investor to accept that much risk. I mean, that's partly why you don't see VCs doing sort of pre-seed deals. It's also why you see government loans financing things like technology development and sort of technology feasibility studies and that kind of stuff. The government's willing to finance some of that, but it's very risky for investors to get involved that early. One of the important things to understand about investors is that they take a sort of a negative approach to thinking through companies. I mean, when I first got into the venture capital business, I found myself getting excited about some of the technologies and products I saw. And I discovered it would be real easy for me to spend hours and days and weeks getting excited about some of these companies, but it wasn't good use of my time. And I kind of flipped my thought process around and said, if I want to manage my time carefully, I got to focus in right away on every company and ask the question, if this company were to fail, why would it fail? You know, what are the risk factors here that would cause the company to fail? And so then you make a list. You know, maybe there's 5 or 10 significant risk factors, and you go down through that list, and you either get comfortable that you can live with the risk, or you find a way to avoid it. And if you can't, so risk management is important. Risk management is an important part of the thought process. And I've got these kind of in a sequence here on purpose. Because one of the things we're going to talk about is bootstrapping, sort of doing as much work as you can without going out and raising capital. And I recognize not every company can do that, but these days a lot of companies are able to do some bootstrapping. If you can bootstrap a company to the point that you've eliminated the technology risk, you've developed a product, you've shown that it can be developed, you've shown that it can be manufactured for a cost, you've shown that the product works, you've shown that the product solves a problem, you've got a few beta sites out there, you've placed some product with customers, the customers are happy and they're writing you nice reference letters, you've eliminated an enormous amount of risk. And now when you go to investors, it's really more about management execution risk. Can management get the job done? And then the risk that's remaining is, can we scale this up? You know, is this something that we can scale to a national level or an international level? And that's a risk that investors can get their arms around. I mean, they can do some diligence and figure out if they're willing to accept that risk or not. So we'll talk about that some more, but this is kind of the fundamental argument for bootstrapping your company as far as you can and taking as much risk out of the equation as possible. Let's talk a little about the value of companies. There's a subtle thing that happens here, and I'm not sure many people really understand it. I've got two companies. I've got company A and company B. They have the same forecast, $75 million in 5 years, $9 million in profit in the 5th year. In the case of company A, investors buy the story and they're willing to put some money in, and maybe after the $1 or $2 million goes in, the company's worth $4 million. I mean, I'm just to make an example here using some numbers. But in the case of company B, investors don't buy this story and the company doesn't get funded. What's its value? I mean, its value is really nothing. So the point I'm making here is just that the real value of a company depends an awful lot on investor perception and whether they are participating, whether they're putting money into the company or not. I mean, you can say all you want about your forecasts and your projections, but there's not really value there unless you've been able to persuade somebody to put some funds in. Talk a little about the Fundable CEO. It's just a statistical fact. If you Google around, do some background search, you find that successful CEOs on average have at least 15 to 20 years experience, and most of them are 45 or older. When I was at TRW, I was actually acting as a division general manager for about 1.5 years, and I liked that, and I wanted more of it, but I looked around and realized that the average division manager in TRW was about 55 years old. I mean, at that time, I was in my early 40s. So if I adopted that as a career path, I would have had another 10 years or something like that, probably before I could have qualified for another assignment. Most CEOs have climbed the corporate ladder. Here's an example of somebody who starts out as an engineering officer and moves up through different layers of manager to assistant general manager, deputy general manager, which in a large company, in a division of a large company, is kind of the equivalent of a CEO kind of slot. You can't underestimate the value of that experience. It really is a learning process. There's a lot to learn. I mean, it's planning, it's execution, it's hiring, firing, motivating, managing, and there's a difference between managing people, guys who are really doing the building blocks versus managing other managers. It's a different kind of experience. Not to underestimate that, the value of that experience. Um, is there a shortcut to having those kind of skills? I mean, is there an incubator or an accelerator or something that can take an inexperienced founder and turn him into an experienced CEO? Not really. I mean, I don't know how you compress that learning cycle into any kind of a short period of time. Just to give you a couple examples about the importance of a CEO and how they work, these are case studies from the Fundable Startup. DRC Computer was started in the late 90s. The invention was reconfigurable computing, a very high-powered way of sort of merging hardware and software in a way that you could build a computer that could be re-architected on the fly. I mean, the underlying architecture of the machine could really be redesigned on the fly in a software, firmware sort of way. It was a good idea, attracted some attention, got some customers. The founder was a very bright technical guy. And he built up a staff and got some contracts and had some revenue, but he was not able to raise venture capital. And the primary reason was that he insisted on being the CEO, and the VCs just didn't see him as the person who could build a successful company. So when the dot-com bubble came along, that company crashed. But I went to him and said, Steve, I think you've got a really good idea here. We could probably build a company, but we're going to have to bring in an experienced CEO. And he said, fine, do what you need to do. So it took us a couple of years, but we found a guy who had been the VP of operations for Tandem Computers up in Silicon Valley. And he was sort of in between us. Raised $7 million, went out in the company and sold it, and he has the most powerful gene sequencing computer there is. Another example, this is a little different way of coming at the CEO issue. Novodyne Therapeutics is a vaccine for staph infections, and that's a company that I helped start in 2003. And I served as the early head honcho. You know, I didn't have an official title, but I was acting like chairman and CEO. It was about a day a week kind of job of just pulling ideas together, looking at different options. The technology was in an animal testing phase at that time, so it was kind of a slow-moving process. But then finally, we put together a business plan and went out and got a commitment for $18 million from Domain Associates, one of the top biotech venture capital funds. And the deal there was, as soon as we get some money in the bank, we'll go to one of the executive recruiting firms and recruit a CEO from the industry, so from the vaccine business. So in that case, I served as a sort of bridge to a CEO that the venture capitalists considered to be fundable. And then Parcel Pending is interesting. A lot of you probably know Lori Torres and know her story. Even before her company really got up and running, I wrote a case study about her in the Fundable Startup. And my message was that I thought she was the kind of CEO who had a pretty good chance to succeed, even though she hadn't been a CEO before. I mean, technically, she was not, you know, you could argue about whether she was a fundable CEO of a company, or it's all stuff hiring, firing, and finding, and all the mechanics that you have to do to manage people effectively. So it looked like she had the right kind of background, and sure enough, she did a great job of building Parcel Pending and selling it for over $100 million in 2018. It's important to think a little about what I call company building skills. And this kind of comes up in the context of startups that want to bring in CEOs or managers who have been successful at large companies. And it just doesn't always work. And one of the reasons for that is that the skill set required to build a startup is kind of different. They're not necessarily skills that you learn in a large company. And here's some examples. How do you go out and find the right lawyer to incorporate a company? How do you go through that process of incorporating a company? There are a lot of decisions that have to be made. How do you allocate stock in a company to build and motivate an initial team, a founder's team in a company, or maybe an implementation team? How do you sit down with a blank piece of paper and write a business plan? That's something that most executives in corporations have never had to do. To just start from scratch and create a business plan and a competitive analysis and a competitive strategic positioning plan. How do you create initial value in a startup? Again, that's not something that you learn in a large company when you're basically just there as the overseer of a system that's put in place where every quarter you do this plan and this plan and this plan and update this and update that. You're not learning some of these fundamental steps that you have to learn in a startup. Another one is, how do you go out and get your first customer? How do you get somebody to try something for the first time? And how do you service that and turn that into repeat business? I could go on, and I think the list is longer in the Fundable Startup of these kind of company building skills, and it's important to be aware of. Some startups are just some just way too quick to assume that because somebody's had great experience in a large company, it's going to work well in a small company. It's not necessarily true.
Fred, there are a couple of questions. Would you like to take them on?
Sure.
If you click on Q&A, you can see them, but it says, so Mohan is asking, where can one turn to in order to fill a few slots in a management team? You touched on that earlier.
I'm looking for the Q&A.
It's at the bottom. But I can repeat the question.
I see it. Okay. I understand the question. Well, finding people, of course, is a challenge. I mean, I don't know how to answer that other than to say networking. I mean, startup companies probably don't have the luxury of going to executive recruiters. I mean, they're unless you can find one that's willing to work for stock or stock and cash or something like that. So you probably have to just go out and do a whole lot of networking and ask a lot of people. One of Lori Torres's little mantras I really liked. She said, I can solve any problem. I just have to find people who can help me solve it. I think you can't underestimate that value of finding people. I mean, that, in some ways, that's your challenge as the founder of a startup. It's finding the people who can help you make things work. Short of going out and doing a lot of networking, going to events, contacting people, getting emails out, writing job descriptions and sending them around is a good way to do that. I mean, you know, if you say, hey, I'm looking for a web developer, right away, people, the reaction is, well, what does that mean? I mean, what do you really want them to do? So writing down a job description and circulating it in your network is probably not a bad idea.
There's one more question. The next one is, do you see it?
I see the Q&A, but it's not opening up for me. It may be hidden by my screen.
Okay, I will read it for you. Is there a bias of VCs and angel investors towards investing in digital or app products?
Hard question. Let me answer. I'm going to answer that in a couple different ways. I'm going to answer yes, and I'm going to answer no. If you look back 30 years or so, the venture capital world was focused primarily on chips and technology. And that evolved through several different iterations of chips and application-specific integrated circuits and more software and kinds of things. And if you look at it today, there's a lot more of what the questioner referenced, apps and software, digital applications, that kind of stuff. So yes, there's been a huge evolution in that direction. And if you look at it today, the old-fashioned technology is probably just the tip of the iceberg. The iceberg is probably apps and software and all this other stuff. So that's the answer. For me, the no part of the answer is really difficult sometimes to do due diligence on apps and software. It's very hard to figure out who the winners are going to be, and a lot as you're dealing with consumer as a buyer, you know, business to business is not too hard to figure out. But if you're dealing with business to consumer, and the consumer is the buyer, it's hard to figure out. I mean, how do you know which restaurant's going to work? How do you know which food delivery service is going to really take off? So while I think there's a lot more of those kind of opportunities, I also think it's a lot harder to get your arms around those and a lot harder to do really good due diligence around those kinds of projects.
These are the only, well, there's one more follow-on questions, and then maybe you can continue. How does one value the startup initially to offer stocks to management team as incentive? Is that outside, or are you going to touch on that?
I wasn't really going to talk about it. The book does talk about it. I mean, my ultimate answer for valuation is that startups should learn how to do net present value calculations, discounted cash flow calculations. That's how the VCs are looking at deals. It tends to give pretty low valuations, so it's not necessarily the final answer, but it forces you to really think through assumptions about your revenue and expenses and costs and potential profits and cash flows, future capital requirements, all that bunch of stuff. You build a 5-year model of the finances of your company. And if you Google around there, you can find some pretty good articles on how to do net present value valuation for a business, or discounted cash flow valuation for a business. It's a good exercise because it sort of forces you to really think through your assumptions, and it also gives you a good basis for talking to investors. The other thing I would say about that is, remember that investors are professional company valuers. That's what they get paid to do. So don't insult them by telling you you've done all the homework and you know what your company's worth. They're probably better at valuing companies than you are. You may not like that, you may not like their number, but you want to be a little careful not to insult them when you present your thinking about valuation.
All right, these are all the questions so far.
So this slide about entrepreneurship, CEOs, and successful startups is sort of an interesting, very high-level view of things. One of the themes I dealt with in writing the Fundable Startup is I kept asking myself the question, where does entrepreneurship stop and professional management start, or is there such a boundary? You know, we're teaching a lot of people about entrepreneurship, but is that going to make them people who can go out and build a successful startup? I mean, you know, if you teach young people a lot of entrepreneurship, you still haven't given them the 20 years of management experience they need to be seasoned CEOs. So how do you piece all that together? So I did a fun little study about a year ago. I forget the exact numbers, but I pulled up all the articles I could find on CEOs and all the articles I could find on successful startups and all the articles I could find on entrepreneurs. And then I went through and looked at what words were mentioned the most in each of those categories. And you know, there were in each one, there were probably a dozen words that kind of stood out. But it was very interesting. In the entrepreneur collection of articles, the word that was used the most by far was passion. I mean, and that, you know, that sort of rings true. If you think about how we think about entrepreneurs, we think about passion, determination, stubbornness. You know, I'm gonna find a way to make it work, and that's fine, but maybe not sufficient. Probably necessary, but maybe not sufficient for success. In the CEO articles, the word that stood out the most was the word process, which hardly showed up at all in the entrepreneurship articles. So for me, that little study kind of highlighted a difference in emphasis. I think building a successful startup can be largely about entrepreneurship, but it's not just about entrepreneurship. It's also about process and the steps you have to go through to build a successful company. And then the other one that was a little bit of a surprise to me, but I guess maybe it shouldn't have been, was my articles about successful startup companies. The word that jumped out the most, it was actually a phrase, it was a market understanding. That was sort of the key thing to building a successful startup company, and it wasn't mentioned a whole lot in either the CEO articles or in the entrepreneur articles. So that it's an interesting little perspective. I mean, obviously you need all of those things, but when I think there are people who sort of equate startup success with entrepreneurship, and I think that's a little short-sighted. I mean, it's a little misleading because it leaves out the importance of management process and the importance of understanding markets. So one way out of this for companies, I mean, if you're not a seasoned CEO and you don't have a good path to a seasoned CEO, probably your best alternative is to bootstrap your company. And by bootstrapping, I mean just take it as far as you can without capital, or maybe on a very small amount of capital, you know, money from friends and family. One of the successful companies in my portfolio is a company called LiveSafe. That is an app for crime reporting. And they did just a magnificent job of using their initial stock to build a little implementation team. They built the product, they got a few customers, they got some national recognition, and they were able to leverage that into some angel capital. And as they went about their angel fundraising, they ran into a guy who had been the CEO of a very successful company, and he got interested not just in investing in the company, but in actually coming in and running it. So it was a really good pull yourself up by your bootstrap kind of process. Started with a team, led to a product, finally got some customers, a lot of positive feedback from those customers, and the end result is a company which has now had a couple rounds. I think they've raised, I think they got $5 million from Barry Diller's venture capital fund, and then maybe another $5 million from Fred Smith, the founder of FedEx. So it's still a private company, but they're doing quite well. Let's talk for a minute about advisors. I think one of the most difficult challenges for startups is to know who to talk to for advice. I mean, I can't tell you how many startups I've seen go down the wrong path because they just took advice from easy advice from friends and family, you know, the people they knew, which is probably the wrong thing to do. And I'm trying to illustrate a point here. There are people who advisors who have just sort of seen everything. You know, whatever situation pops up in a company, they can sort of tap into their prior experience and say, well, yeah, I've seen that before, been there, done that. I know how to deal with that. And it's probably not someone who just has one or two or even half a dozen startups under his belt. You're probably talking about somebody who's dealt with dozens of startups directly, you know, as a director, as an investor, or as a participant. And there are people like that. I mean, I know there aren't a lot of them, but there are people like that. So I liken it to LASIK surgery. You know, if you're going to have LASIK surgery on your eyes, you go out and find the surgeon who's done the most cases, or second or third or something like that. But you don't go to somebody who's just getting started. And I think the same thing applies here. The best advisors are the ones who have really a broad range of experience. There are different ways to get that. Of course, venture capital is one of them, and most of those guys are too busy being billionaires to be advisors to companies. But that is part of the value of getting venture capital into your company, is you're probably getting a director who has been involved with dozens and dozens of companies. And most of those guys, or at least a lot of them, are really good, experienced, seasoned company builder kind of people. Quick comment about crowdfunding. I think, especially in today's environment, I mean, I think things are slowed down some because of COVID, that's for sure. Crowdfunding may be an alternative. We had at Money Club, we had a company the other day that has an interesting COVID solution. It's in addition to a mask, you actually wear a breathing apparatus that pumps some material into the air that kills the COVID virus. So you're not just filtering air, you're actually killing the virus. You know, the short-term opportunity there is to help people who really have to travel during the infection time here. So it's a hurry up, get it funded, get it on the market kind of thing. And for them, a crowdfunding sort of situation is ideal. From the company's point of view, I think crowdfunding represents a pretty good opportunity. Valuations can be pretty attractive, and the amounts of money can be okay. The thing I worry about from the company's point of view is, well, what happens next? I mean, if you get your valuation pumped up too high, or you don't get enough money to achieve some truly meaningful milestones, you may have sort of painted yourself into a corner. This slide is written a little more from the investor's point of view. I don't know how the crowdfunders really make it work. I mean, they don't have the tools that the VCs have to do really good due diligence. A lot of them probably don't do the kind of competitive analysis that should be done, or the reference checking. They may not be very sophisticated about valuation, and they're probably not able to do enough deals to get a diversification across 35 different companies, which is about what the VCs need in order to build a fairly safe portfolio. So it'll be interesting to see in a couple years what kind of returns investors are getting from crowdfunding, and how much follow-on companies are able to get from crowdfunding. My preference would still be to get money from angels or VCs if possible. Comment about pitch decks. I obviously see a lot of pitch decks. I see a real trend recently in the last couple of years. Somebody thinks that it's cute to pack pitch decks with pictures. The slides I've used today, by the way, are sort of opposite my normal strategy. I mean, I'm using a lot of graphics, but that's because I'm here to talk about it. You should not assume that you're always going to be there to explain your pitch deck. I mean, sometimes you're going to use your pitch deck to try and get an investor's attention and get a first meeting, or a VC may pass it on to his partners, or he may pull it out of his desk 60 days later as a refresher. So you can't assume that you see an awful lot of pitch decks that have graphics that just are not self-explanatory. They're complicated. They don't really explain what's going on. Sort of leads me to say I see a lot of it would actually be more effective communication if you just wrote down 6 words, you know, make a short little bullet point. I mean, in the end, it's really about the message, it's the substance, and how well that's being communicated. I think the safe assumption is that those slides to somebody. So that's wrong too. You don't want a lot of words on the slide. You don't want people reading while you're talking. So you want to stay with short bullets, but you can say an awful lot with short bullets. So that's what I had to say for this morning. JJ, glad to do some other discussion or questions if there are any.
Well, thank you very much, Fred.
Take off the screen share.
Yeah, you can. Yeah, and there's a couple of questions. I'll read them for you. One is that says, "How?" It's a hard one, but I hope you have an answer. How does one maintain confidentiality of an idea when asking for seed money. Sharing the idea and innovative process to solve the problem exposes concepts to public who may take the idea and possibly compete with the founder of the new startup. And he's saying even a pitch competition like Tecos Angels or a business plan competition like we were doing kind of exposes it as well.
Yeah, it's a good question. Several answers. I think one is in some cases, and I don't know if it's the case here or not, but in some cases, the technology is kind of rich enough and deep enough that you don't have, investors don't have to know the whole story, especially not right off the bat. So sometimes you can sort of summarize, but you don't have to give them the patent application. I mean, you don't know of the details. So I guess solution number one is, can you summarize in a way that conveys the essential information, but doesn't convey the proprietary information? The other thing I would say, and I've been up against this problem more than once, the other thing I would say is if an idea is so fragile that the mere whisper of it would cause other people to go do it, then maybe it's not what investors are looking for. I mean, we haven't talked a whole lot about an important criteria that investors have, and that is sustainable competitive advantage. Investors want to know that they're investing in ideas that have a 15 or 20-year lifetime, that they have some kind of proprietary advantage, whether it's patents or proprietary process, trade secrets, something that sets it aside and makes it difficult. So if an idea is so mere whisper of it could launch a competitor, then you have to wonder if it really has sustainability and enough competitive advantage to attract investors. I'm not hearing you. Are you muted, JJ? I'm not hearing you.
Yeah, I'm sorry. Yeah, I was going to say these are the only questions. If anyone has a question that would like to come in for a live question via audio, video, please raise your hand and then we will let you in. Here we go. We have already someone that is raising their hand, and this is Deepu. And give me 1 second and I'll make you available. And then we have Anthony as well. Deepu, go ahead. You need to unmute.
Sorry. Okay, can you hear me now?
Yes, not so loud, but maybe get closer or something.
Okay. Is it okay to put your pitch deck on your website, or would that constitute a public solicitation?
Is it okay to post the pitch deck on a website? Is that what you said?
Yes.
That's the question, Fred. Is it okay to put your pitch deck on a website, potentially for someone that's looking to raise capital?
Or would that be a public solicitation and run afoul of the securities laws?
I can't hear you very well, Deepu. I'm sorry. Fred, any? Oh, Fred looks frozen for a second.
JJ, I posted the question in the chat box.
Oh, in the chat box. Okay. Is it okay to put your pitch deck on a website, or?
I think I've got enough to. A lot of companies, a lot of companies do put their pitch deck on the website. I don't see that it's a big problem. There might be a question for a lawyer. I think he was kind of breaking up, but I think he also asked the question: is that could that be seen as a public offering or something like that?
Right.
I would be a little careful about that. You might want to ask a lawyer about it. I guess my real question would be, what do you hope to accomplish? I mean, the people who are going to come to your website and take a look are probably more interested. I would rely more on targeting to get your pitch deck in front of the right people. So I wouldn't expect much in the way of results from just putting it on your website. And I would check with the lawyer and make sure you're not violating some kind of registration regulation.
Okay, Anthony, do you still want to have a question? Because you had your hand raised. If you do, please raise it again. Here we go. Okay, go ahead, Anthony. Unmute.
Okay. Fred, thank you very much for your talk. I actually own your book and I've read it. So your talk actually has been very beneficial. So quick question. I'm a judge in this competition and I'm on an advisory board for a startup. The startup is, and the startup is not participating in this competition, but the startup is an R&D effort to exit. And the reason that it's an R&D effort to exit is it's 8 guys building technology, designing technology that's going to go on jet airplanes. So in other words, 8 guys cannot service the entire airline industry of the world. The technology will have to be immediately acquired by Boeing or Airbus. In that perspective, what do you do with a company when it's an R&D effort to exit? Any thoughts?
Anthony, you fell off a little at the end. I missed after the last sentence. What do you do about what?
What do you do when a startup is an R&D effort to exit? In other words, you're not going to sell X number of widgets to Y number of customers and make Z number of dollars. You're going to design technology that will be immediately have to get acquired so that that technology can hit the industry.
I'm not sure you get a lot of interest from either VCs or angels in that.
Oh, wait, Fred is frozen again.
Process. Maybe from an angel. I mean, guys who run around.
Okay.
There are guys flipping them real quick, but most of the investors are looking to build value in a startup and exit over a 5 to 7 year period of time.
Yeah, that's what I thought. I thought that an angel would make the bet and then it would be immediately acquired by an industry participant. And you're confirming what I'm thinking. I appreciate your answer. Thank you.
Yeah, I mean, you might find that. You might find somebody willing to do that, but it's sort of outside the normal process.
Okay, no, I appreciate your answer. Thank you.
Thanks for buying my book.
You're welcome.
Thank you, Anthony. Appreciate that. Anyone else would be interested in asking Fred a question? So we have the virtual networking right after this. It's Friday, so consider it happy hour. Yeah, early happy hour for 10 a.m., but it is happy hour for a Friday. Any other questions that we can answer for you? Fred is here and available, either in the Q&A or live. All right, we'll give it another 10 seconds here. If no one raises their hand, we'll move on. Oh, here's Ong. All right, Ong is, go ahead, Ong. You're on, unmute.
Can you guys hear me?
Now we can.
Okay, great. Thank you. Thank you for taking the time to share your the presentation and also your knowledge with us, Fred. So here's the thing. I've been in a different industry for many years, almost 20 years. But then I'm bringing the passion that I grew up with, I guess I'll just share with you. It's basically it's the entertainment industry. My family grew up in, so I saw the need and then the problem exists. Not only in the U.S., also globally. So that's what I'm trying to solve the problem and trying to build a platform. So my question is this: looking at I understand the tenure is important, experience important, because that's experience is something that you can't teach, right? So, but then having said that, like how much of I guess leniency that when investors look at it from perspective of the founder or co-founder can bring to the table, that's kind of like let's just say transferable experience in sales, marketing experience, even though it's not the same industry. How much of that leniency can they look at, or do they prefer to bring in another outside CEO in the industry to be considered as a fundable business model?
Good question, hard question to answer. I mean, I probably don't know enough of the detail. I would refer you to my little story about Lori Torres. I mean, she, and actually, there's a point here that I'd like to elaborate on a little bit. Lori had extensive management experience, and she was able to parlay that into success as a first-time CEO. One point that I would make is I see a lot of founders who tell their story. They don't really tell their story about their career and their management experience. I see a lot of slides where the team slide has 6 pictures on it and a couple titles. This guy worked at Xerox, this guy worked at IBM, this guy worked at TRW, and that's the end of it. And when you really get into it and you say, well, wait a minute, why would an investor invest in this CEO? They say, well, it turns out that they actually have some pretty good management experience. So I would document your experience, tell your story, see how close you can come to convincing people that you've got enough experience to pull this thing off.
Okay.
And whether it's enough or not, I don't know. I mean, again, the investor you're talking to is sitting there talking to some people who have a lot of previous success. I guess another thing you're kind of facing, I don't know exactly what kind of a product you're building, but entertainment industry tends to be kind of a thing by itself. I mean, the venture capital and angel investors don't necessarily do a lot of deals in the entertainment industry.
Yeah, it's a little bit of I guess disruptive way of approaching. I mean, not only Hollywood, we're talking the entertainment industries as in like music, the performing arts, theater. But anyway, I'm trying to build a platform, but my background is in sales, 20 years, but I'm coming out of mostly 16 years in pharmaceuticals. So, but my family always has been in the film business. And I started out in music. So, that's where the passion is, But anyway, yeah.
Just be sure and tell your story about your own management experience, and don't be bashful about it. Maybe a separate slide, maybe a resume, but make sure the investors you're talking to understand your background and what your strengths are.
Great, thank you so much.
Thank you, Ang, very much. Thanks, Fred. We have a couple of questions in the Q&A section. One from Stephen that says, is there a threshold ROI that a VC needs?
That's a really good question. The ultimate objective of venture capital funds is to provide a return that's higher than you can get from real estate or the stock market. And of course, that's a little deceptive because there are mutual funds where if you look at the past 10 or 20 years, you could be making 20% return or something like that. So what does that mean? It's generally taken to mean that their overall returns want to be in the 25% annual return or higher. But that number has really jumped up and down. I mean, there have been years when it's been higher. There have been a lot of years when it was a lot lower because of economic conditions, stock market conditions, et cetera. So their overall return is, do better than the other investment alternatives, and maybe 25% is not a bad way to think about a target. But for individual deals, if they set their hurdle rate for individual deals at 25%, by the time they lose almost half of them, then their returns would be much less than 25%. So the hurdle rate for an individual deal, their target return on an individual deal is probably more like 60, 70, 80%. I mean, when the VCs do their discounted cash flow calculation, they're probably using a discount rate up in the 70 or 80% range. When angel investors say, I want to make 10 times my money in 5 years, that translates to about a 65% compounded return. So somewhere in that area is probably how they're thinking about a hurdle rate. But you got to remember, they're going to end up losing almost half their companies, and a bunch of them are going to produce terrible returns. I mean, their returns are going to be created by
That's the longest phrase so far.
probably maybe 20 or have 1 or 2 acorns that make the average pretty much a statistical.
All right, you froze for a bit, Fred. All right. Any other questions? I think we have, we do have a couple more questions here. So Stacy asks, any tips for angels to minimize risk? We usually invest very early stage, so the risk is far greater pre or low revenue.
Well, first comment would be, in the venture capital world that I know, the VCs also invest at very early stages. I mean, it's probably less today because the funds have gotten to be so large, but traditionally VCs also do seed and startup deals. So they're facing that risk. My number one piece of advice to the angels, I think, would be make sure you're getting enough money into your companies to achieve some significant milestones. I mean, I've seen the angels over and over sort of make the mistake of building a bridge halfway across the river. It turns out in retrospect that the company really needed $2.5 million to get to the next milestones, to get the product out, get some customer feedback, step up the valuation so they could go out and raise more money at a higher valuation. But the angels say, well, all we can get is $1 million, so we'll just go ahead and close on that and see what happens. To me, that's a big mistake. It's really important that you get enough money into these companies, along with some cushion. They need 6 or 9 months cushion to go out and raise the next round. You've got to have enough money to go out and achieve some really significant milestones.
Thanks, Fred. Another question from Stephen. He says, thanks. And do VCs expect a subsequent round so they have to plan for dilution?
Yes.
That's a quick answer.
Well, it's an important concept. And we didn't really talk about it a lot. there is, and this is kind of an important difference maybe between venture capital investors and angel investors. Angel investors don't like dilution. They don't like capital intensive companies. They don't like to have to come back and put more money in. But for VCs, that's just part of the deal. I mean, the VCs expect to do the Series A, Series B, Series C, maybe Series D before they actually get a company public. And they know there's going to be dilution. They're planning on that. And they're not too put off by it. The challenge is, well, it's the old thing you've heard before, you know, yeah, it's a smaller percentage of the pie. Hopefully the pie has grown enough that we end up making a lot of money. I mean, a lot of venture capital deals, they might go in and initially own 20% of a company or something like that. And after all the dilution, maybe they only own a couple percent. But if you get a unicorn exit, you know, a couple percent of $1 billion is not a bad return.
Yeah, yeah. All right. We have a question from Mark. Mark says, what is the simplest way to identify angel investor groups within your business segment, knowing that most investor groups only invest in certain target business segments?
I don't know, that doesn't jive real well with my experience. I mean, like Tech Coast Angels, for example, is not targeted. I mean, they don't cover every conceivable segment, but it's very broad. I think you just have to approach Tech Coast Angels and see if there's interest in your sector. I'm not sure investors are, well, let me say it this way. It generally doesn't work very well for investors to target narrow segments. Healthcare maybe, chips maybe, apps maybe, software maybe, those kind of broad sectors. But the more an investor narrows his sights on a target sector, the more opportunity he shuts out. And the problem is you can't find enough opportunity to build the diversified portfolio you need. So I would not view investors as highly targeted. Most of them are pretty general purpose. That's not to say they'll do anything. Yeah, they have their specialties, but I wouldn't try and select on that basis. I would just approach every group you can find and sort of find out where their interests are and run your ideas past them and see if it's something they can deal with.
All right, thanks, Frank. Last question, and then we're going to ask everybody to jump to the networking session. It's virtual networking on HIO. All you need to do is log in using the link that you have in the chat. Also put the password if you need to, otherwise you'll jump right in. And then you can create a table and join others. So please join us there. Fred, the question from Gary is, thank you for your time. What is your experience or opinion on the success of safe notes as opposed to trying to value the company?
Yeah, it's good question. Very, very topical. Well, first of all, I certainly like safe notes better than convertible, the previous form of convertible notes. The problem with
yeah, you're talking about the KISS, right?
Well, SAFE, I forget the acronym, but it's basically a convertible note that specifies what's going to happen on maturity. You know, what happens if we don't raise Series A? That right. Was the problem with the old convertible notes. Too many of them were either silent on that question, well, what happens if the company doesn't raise Series A, or you know, terrible things happened. The note converted to a demand note for the investors, so the investor, you know, secured by the technology, so the investors could take the technology, And what you really wanted to have happen, the obvious thing, at least from the company's point of view, was the note should simply convert to a percentage of the company's equity at a pre-specified valuation. That's what the SAFE does. That's basically the whole thing. But but that's only part of the answer. Investors don't like that mechanism, and the reason is that if I'm coming in at very early stage, you know, seed or pre-seed or Series A, I'm taking a lot of risk. If you remember my slide, I had a dozen risks listed out. I'm taking all those risks. And if we're able to work through those, you know, numbers 1, you know, 10 out of 11 or 11 out of 12, for example, and then go to some venture capital investors for Series B, then why should I only get a 20% discount to the Series B price? I mean, I've taken all the Series A risk, and then the Series B guy comes along. What I'd like to do is step the value up 3 times, take it from 4 million to 12 for the Series B guys. So why should I pay almost the whole Series B price when I took all the Series A risk? That's a real problem for some investors. Some of them kind of overlook it, but to their peril, in my opinion.
All right, thank you very much, Fred. I think these are all the questions. Fred, I really appreciate the time, the energy that you put into this, and all your insight. This has been great. I've learned more today, and I'm sure everybody that's been on this webinar has learned as well. Thanks again for being part of this.
You're welcome, JJ. Thank you for inviting me. Thanks, audience. Good questions.
Thank you. And we will see you on the judging in a couple of weeks, I guess.
Yep.
We'll see you around. All right. Thanks so much. Talk soon. Okay, let's go to the networking. If you can, Fred, join us there too.